Welcome to the third webinar at Rosecut, How to Invest Through a Recession, the Challenges and Opportunities. I'm the co-founder and CEO of Rosecut Advisors, and together here with me is Michael Sullivan, investment advisor at Rosecut. Hi, Mike.
Hi, Qiaojia. Hi, everybody.
So let me quickly give you a background of Mike. I've met him since, 7-8 years ago now. And when he was the Chief Investment Officer of Credit Suisse UK. And then before I knew it, he became the Chief Investment Officer of Credit Suisse Europe. And then another couple of years later, he became the global CEO of Credit Suisse. And just, his responsibility grew and grew. In terms of the role of a chief investment officer, for the people who don't know here, it is about thought leadership of the decisions of what the investments the private banks investment managers are about to make. So they meet on a bi-weekly basis and then sort of steer the decisions on the investment mandates, if you like. And here, Mike today, is to share some of his thoughts on his insights and expertise of investing through a recession. Today's session will be about several blocks of content as we usually do it. We will do a quick intro of where we are today and what a recession means, as some of you probably already know. And we will talk about the dynamics of recession and specific industries that you might find interesting. And then we will share our ideas of cycle of seasons and how you could use this framework for investing. The risk warnings as usual, so we just leave this page here for you to have a quick look. As always said, investing involves risk. That means your investment can go up or down. And also, this is not investment advice. We will encourage you to take up investment advice sessions with myself or my colleagues at Rosecut before investing. So let's address obviously the elephant in the room. And Mike, this is a quote from your works. Can you tell us what this means?
Thanks, Qiaojia. Hello, everyone. And thanks for joining on such a hot and sweltering day. I guess the topic today, recession, is not a very optimistic one. We're in very, very strange times. So first of all, just a word on the presentation today. I will try not to go on too long. I think if there's anything I gloss over that is not clear, please come back to it in the Q&A session, or just feel free to send us an email later on. So I guess what I do to start is, if I go back to January of this year, we had been in the longest business cycle expansion ever. I think many of you will kind of intuitively understand the fact that economies and I think countries as well move in cycles. You get a slowdown, a recession, then you get a recovery, and then things begin to get stronger. And normally these cycles, if you go back to sort of 1850, they last for about 5 years. And what's been unusual in the last 10 years, we just had one kind of long, kind of lazy period of business cycle expansion. So there hasn't been any real downturn. There's been lots of events, lots of things happening in markets. But if you've been in industries like private equity, real estate, it's actually been really good because you just had this kind of continued growth. And that's all been cut dead by the coronavirus. And also, I think the fact that many, what economists call imbalances have been building up in the last couple of years. And, everyone is talking about these now: end of globalization, inequality, etc. They're all coming home to roost now that we've had this shock. So the sort of the short-term economic climate has changed dramatically. And the other thing I think that's interesting is that lots of the long-term forces that have been acting on markets and economies are now right out into the open, and they're affecting portfolios, investments, and trading as well.
Yeah, so I think this is the question a lot of people have asked us at Roscat, to say, now we are obviously in the recession, and do we even need to invest at all, right? So the numbers from the real economy hasn't been looking great. In the latest report on the 14th of July, the UK Office for Budget Responsibility said the country is on track for the largest decline in GDP, gross domestic product, for 300 years, with a 2020 contraction of 12.7%. And it says that all this lower output and rising cost will push national debt as a proportion of GDP above 100%. And UK is not alone. If you look at Europe, Eurozone, as well as US, they all have reported in the past 2 weeks of massive shrinkage of their economic activities, either by 20% or 30%.
I guess you've got the slide there, which shows just the length of expansions historically, and people will just see that this has been, I think, the second longest expansion we've had since 1850. We just jump forward 1 or 2 slides. Yeah, so I'd say 2 things just to add a bit of context. One is this presentation makes me feel very old, because not having had a recession in the last 10 years, we have plenty of people working in the city or in private equity, whatever, who haven't experienced a sort of good old-fashioned recession. And the sort of training I would have had, and anyone who studied economics and finance right up to the 2000s, is sort of the textbook is that you have these recessions every 5 or 6 years, but you haven't had them. But you've had lots of other things. And the second thing to emphasize is that the world has slowly been kind of cooking itself to death economically and in terms of climate change for the last 20 or 30 years. You've had this great period of globalization where so many, I think, great things have happened. Poverty has fallen in emerging countries. People generally have been made better off, and that's come to an end. And so many things are now at extremes. So the role of central banks in markets and economies, if you look at the size of central bank balance sheets, how much they're buying, that's at a record. Indebtedness is at a record as well. The world is now more indebted than after the Second World War, and almost as indebted as it was, compared to GDP after the Napoleonic Wars. And there's just this general feeling, that I wrote a note at the weekend saying that, with the events in Beirut, I think people have this overwhelming sense that we're at a kind of a turning point in history and economics and finance and politics and all these other things. There's so many events happening. And that I think is because many of the economic forces of the last 30 years are coming to an end, and new ones are beginning to emerge. So it's a very complicated environment. I think the point I'm trying to get across today is that when you talk about investing, it's not just about investing in equity or in certain kinds of equity, in tech stocks or in Bitcoin. It's about having a sort of balanced approach, and also an approach that can change over time. But maybe we go through 1 or 2 of the following slides if you want, just to illustrate some of the points.
Yeah, I think, we can cover more about the investment approaches later on. And it's really good that you paint a picture for us, what's going on in the world. And so, one of the audiences, James, asked a question about, why do we invest at all during recession? Because his logic is that, recession would lead to stock market declining, and it's better to buy near the bottom of the market. Yeah. Someone would know what that is. I just need to find the right advice and right person to tell me that. And then, so, it's probably sensible to hold cash or similar until I know it's the right time. So, what do you think of that comment? And that kind of approach?
As they say, this time it's very different. And I say that somewhat ironically, because there are certain things that just do not change. I think many of the things we've had to deal with are more extreme. So in terms of approach to investing, in a recession, stock markets would typically start to underperform when you get into the recession. So when the GDP data, retail sales, corporate profits begin to turn down. And as that happens, you tend to be switching from things like equities into bonds. Historically, again, you go back a long time, cash is actually a good place to put your money. But cash today, in many cases, and certainly short-end government bonds, is negative. So you're being penalized for doing so. The other thing I think that's different is you have this kind of contest between indebtedness and central banks. The next slide shows you how high indebtedness has become. If you look at debt to GDP over time, it's been growing steadily. And one of the things debt does is it slows down economies. It's a bit like an athlete getting older, or someone who's got too much weight. You just can't run as fast as you used to. And I think there is a risk in the future that we get some kind of credit crunch. And what I mean by that is that companies, banks, etc., who've got too much debt can no longer service that debt. And you need to get either bankruptcies or debt restructuring or asset restructuring. And I think we will see that probably into next year, and it will create lots of individual opportunities in those asset classes. And I think being in things like distressed debt funds, long-short credit, which are quite complex instruments, will be good, but also having a kind of a balanced portfolio will be good too. Now, if we go to the next slide, the reason that all this debt is not an issue at the moment is that central banks are buying it. And this is really the new thing for the last 9 years or so. So previously in a recession, what would happen is that the central bank would cut interest rates to make the burden of paying back debt more easy. And in the last recession, they did that, and they got down towards the limit, and they said, look, we need to do something else. We need to soften the blow of all this debt. And I'm sure many of the people on the call saw this in the Eurozone crisis when Italy's interest rates began to push up to 7-8%, and the European Central Bank stepped in as a buyer. And that was intended as a kind of an emergency move. It's a bit like a doctor giving you a shot of morphine. And it worked so well, they said, we'll do this every day. And they've been doing it for the last 8 or 9 years. So it's become the normal kind of, policy. So you get a shot of morphine every day and you feel great. And as a result of that, indebtedness, which I think historically would normally weigh on markets, isn't, because the Fed, the ECB are very active. And even, as coronavirus hit, I mean, they were extremely, extremely fast to announce new debt buying programs. And I think as an investor, even if you don't agree with what they're doing, you think they're kind of bailing everyone out, as an investor, you have to recognize the power of what they're doing in markets and the effect it has on asset prices. And that effect has been very, very strong across fixed income markets. And people think it's that quantitative easing is only supporting equities, but it's really helped the fixed income market as well, which tends to be a lot safer. Government bonds historically tend to be a lot safer than equities, and they've done very, very well. So in that sense, to my mind, central banks and central bank liquidity is probably the most important issue in markets today. There's a few other things going on, which I'll just touch on, Qiaojia, over the next couple of slides. One is that the world also has a trade shock. Globalization has come effectively to an end. When trade and migration and all that stuff begin to return to normal, they'll be quite different. And one of the things I think that's been quite worrying in recent months has been the failure of big governments to collaborate. The US with China, the US with Europe. Historically, you've had a lot of collaboration, and you haven't had it this time. You have, more aggression from Trump on Chinese tech, on trade, tensions between Europe and the States. You've got Brexit going on. So the underlying economic world we've known for the last 30 years is coming to an end as a phenomenon, and will be quite different into the future. So that's something, as an investor, you've got to contend with in terms of what stocks you buy, countries you buy, sectors you buy.
Yeah, so Mike, I remember you wrote a book called The Leveling on this post-globalization world. If you tell us, why we should read that book, that'd be great.
Okay, so good time for a gratuitous sort of book push. So I've kind of followed globalization for a long time, because I wrote a book about sort of Ireland and globalization 10 years ago, when Ireland was classified as being the most globalized country in the world. And I wanted to track the effect of globalization on Ireland. And of course, Ireland went from being the world's miracle economy to sort of falling apart in its own crisis, and then bouncing back. And that's a good, I think, illustration of some of the dangers of globalization. So I think globalization has come to an end. And I think if you measure all of its components, trade, the flow of ideas, the flow of finance, they're all dipping or turning or falling down. The collaboration we used to have between countries is coming to an end. And you're getting a more regionalized, what I call multipolar world, where you've got three big regions: the States, China, Europe. And if you look at how they've all dealt with the coronavirus, they've dealt with it in very different ways. In the US, there's been much more tension between the economy and treating people. In China, they've dealt with it very quickly. In Europe, there's been, we've seen the value of kind of social welfare systems in Europe, and a more socially oriented approach. And then if you look at how all these regions deal with the internet, it's exactly the same. They're going in very, very different directions. And that, I think, is the future ahead of us. And it's also an interesting time just to note the slide you've put up there. If we go back to the turn of the last century, 1900, which was also a period of globalization, it's very good for seeing how nations have risen and fallen. So back in 1900, the UK had a quarter of the world's stock market. And back then, railways were the sort of the tech stock of the day. I think about 2/3 of the UK stock market was made up by railway stocks. And even then, back then, you had electric car companies who had sort of bubble type characteristics. And what's interesting, if you compare how stock markets have changed, or the proportion of the world's stock market has changed since then, the US has gone from 15 to 53%, Germany from 13 to sort of 3%, the same for France. The UK has been cut back as well. So part of the role of the investor is not just to pick the companies and the sectors, but also to pick the countries, because if you're going to invest on an international basis, you need to get the countries right, not just the stock markets, but also the currencies. I mean, the only currency that's really held its value over time actually is the Swiss franc, and others have been kind of up and down. Back in, I think, middle of the 19th century, you could get $10 for one British pound, and now we're kind of edging towards parity. So that, being able to look at the sort of the cycle of how countries are emerging and falling is actually quite important as well.
Yeah, I think one of the common things we have seen with individual investors investing is that they don't realize they are heavily concentrated on the country they reside. So for a lot of British people here, the job is tied to UK economy, and they are buying London real estate, and the companies that the single companies they buy equities from are the big British names. So essentially, like majority, if not all of your net worth is tied to UK. If you look at the UK's decline, over the past 100 years, it doesn't make sense. So I think one thing that we will address later on is really how investors should have an international outlook and spread their bets across countries, regions, industries, and currencies to really retain the purchasing power of their assets.
Yeah, exactly. Yeah.
So let's talk about the current recession we are in, and this, is what we are wondering: is the stock market behaving normally? Since the crash, let's call it a crash in March, given how it's the biggest fall, by all historical measures, and where we are today, basically.
Just again to show my age and my grey hair, I mean, a recession doesn't feel like this. A recession typically is kind of slower. You get what's supposed to happen is you get sort of a period of expansion, inflation rises, the central bank raises rates, and then everything kind of slows down and dies down for a while. You get a bit of restructuring, etc. What we've had is an enormous shock in the context of very stretched imbalances, all the things I've talked about, end of globalization, inequality, etc. And a generalized feeling that we're in a very strange kind of world where lots of things are turned upside down and are changing. And one of those, I think, is this idea of the gap between Wall Street and Main Street. So in the US, you have, depending on how you measure it, you've probably got between 10 and 13% of the workforce unemployed. And at the same time, the valuation in the stock market, so if you look at the price of the stock market relative to earnings and the sales of companies, it's historically at very expensive levels. And that's something I think that morally a lot of people struggle with, and just logically people struggle with that as well. And I think the reason for it is that the stock market always looks ahead. There's a strong belief in the stock market that the Federal Reserve and other central banks will just continue to provide this kind of sugar or liquidity and keep everything okay. So there's a risk there, obviously, that if the central bank is not as generous as people want, then you get a correction in prices. And I think, Daniel, my rose-cut colleague who runs our portfolios and the investment process, we've kind of, I think, how would I say, been here before, seen some of these discords in markets before. And I think in the real world, people feel a lot of these risks coming through. So far, we've actually adopted quite a sort of a cautious approach. We haven't gone full into equities. We've actually been quite balanced between equities and fixed income. And fixed income actually has done very well. And we are in a strange environment where lots of assets that would normally go in different directions, if that makes sense to people, are all going the same direction. So bond prices, the price of government debt, which is normally a safe asset, gold, which is a safe asset, are rallying. Equities, well, tech stocks have been rallying. Many other equity markets haven't. So trying to play that has been quite difficult. And I think we've got the right mix so far. But the stock market, to answer your question, is not behaving normally. I think there are definitely pockets of kind of outright speculations.
Yes, I think that we have seen plenty of that, recently with some of the tech companies' share prices going through the roof, and some of the companies traditionally wouldn't be, appreciated, such as Hans, and some of the companies are going through bankruptcy, but their share price has increased multiple times as well. So these are sort of really strange behaviors that we are witnessing at this period of time, and it will be very helpful if you explain how we should have a more conservative investing stance, whereas we're looking at some other people through wild risk taking but getting rewarded, at least for now, right? Like, so how would that likely to turn out, for example, if you can predict?
Okay, so just to sort of give context. Many people, I guess, on the call, they work in technology, they work in the city, and I'll give you a few examples of companies and sectors just to kind of give you a sense as to how markets price these companies. So if you look at, for example, the share price of banks or of REITs or property companies, they're all actually pretty depressed. I know that's not great news for people who are working in banks who've got bank shares like me. But the reason for that is that these companies' fortunes are very much tied to the economy and what's going on in the real economy, to what's going on in house prices, the risk of recession, etc. So in those sectors, you probably get a truer sense from the stock market or the bond market of what's happening in the economy. In the tech sector, I mean, you've seen tech stocks rally incredibly strongly since COVID, because there is just this generalized realization that the digital economy and tech is the way of the future, and that many of these companies are, and I'm fingers crossed, Rosecut is a very good example. They're much more nimble, more agile, and they will take business from some of the traditional players, be it in banking or other sectors. And then in the States, you have a small number of tech companies who effectively are monopolies, and they're sort of, the phrase "eating everyone's lunch." Amazon is pushing into lots of different areas. Microsoft or Twitter may take over TikTok, and the market is pricing that kind of monopoly power. So those are two, I think, quite different examples. But if we maybe move to the next couple of slides.
Yeah, so we can dive into specific trends and sectors.
Yeah, so I think in terms of dynamics of a recession, I think what's different now is everything's happening at an accelerated speed. You're getting job cut announcements, but you're also getting corresponding policy moves from governments. An economist, if you read the financial press, the economics community is debating kind of, will the recovery be a V, a W, an L shape? And I don't particularly like that, because it's a bit lazy. And so what I think you'll get is, having had a very sharp fall, you get a bounce back of sorts. And most industries will bounce back to about 90% of where they were. But then a lot of permanent things will change. So working from home is one permanent aspect. The use of technology is another. It's one of the reasons why tech stocks are doing so well. And then another permanent effect, I think, which we need to consider is, and I've mentioned, is indebtedness. And we're at a period now, I think, where many businesses who are indebted have, they are, even with low interest rates, kind of struggling to with cash flows to pay off interest payments. So I think the next 3 or 4 months will be quite a critical time for debt-heavy sectors. It could be property. It could be some parts of the high street. I also think it's going to be a very encouraging time if you are in the sort of the restructuring business. Asset sales, you have an enormous amount of asset sales. So it's going to be quite an opportunistic time as well. In terms of what happens to house prices, I mean, there's lots of people like the IMF have done work here. What happens to house prices depends an awful lot on the size of debt load, the income shock across the economy, and where interest rates go. And when I first bought a house in London, I did so on the assumption that my interest rate would be 5%. Okay, that'll be a shock too, and that wasn't actually too long ago. And I did so on the assumption that I would be able to sort of have room to pay that off if it went higher. So I think the good thing is that the central banks for some time will keep rates very, very low, and that should forestall a nasty correction in in the real estate market. I think people who are very indebted will obviously suffer. And what you're also going to see, I think, will be a shift in the structure of real estate markets, in terms of, from big cities to the countryside, which you're seeing in the UK. You're seeing it here in France, where I am as well. So that will definitely play out. I mean, again, Daniel and I, we've invested in REITs, which are vehicles to access real estate. So I think you will eventually have some interesting opportunities there as well.
So this is where, we find that UK market is in a very distorted situation, like you're saying. On one side, the government has offered free stamp duty for properties at $500,000 or below. And then on the other side, the high unemployment rate has driven some, owners to sell their property. So, if people are looking at this and try to make sense of the big picture, what do you think is a likely outcome? I know I'm asking again for prediction.
Yeah. So I kind of think my instinct, if people are interested in buying a physical property, I would actually wait a few months, wait and see until we get to November, because many of the stimulus packages are beginning to run out. I mean, in the US now, there's a debate on the next stimulus package, and governments cannot sustain this kind of stimulus forever. So I think what you want to see is a couple of months where the property market begins to find its feet. Historically, if you look at IMF data, in a recession, property values will fall between 5 to 11%. In cities like London, price to income values are already very, very stretched. So, find a part of London where you really want to live, you're happy living. And I would wait a couple of months. I mean, there is some talk about property markets taking off, lumber prices going up in the States. And I would slightly discount that, because I don't think we've seen the real economic damage of this event. And that sounds pessimistic, but I think it's quite realistic as well. We've had the shock, and we've had the kind of the adrenaline shot, or the morphine shot, and when we kind of get back to school in September, we'll see the long-term damage.
Great. Thanks for sharing that, even though it may not be great news. So just a disclaimer, that does not serve as financial advice, just sharing of our views only.
Yes,
And now we move on to the third section, a cycle of seasons. And this is our framework of how to make sense of all these things that we have talked about, and how we can help you to invest for your future. So as Mike already mentioned, we do respect his gray hair, but also for each one of us, we will go through multiple cycles, business cycles in our life. It's not like, any of us will be able to escape that. So knowing how to understand all those business cycles and how to handle that, and how to look after your assets is of crucial importance here. So we're about to share some ideas with you.
In the investment process that we've built at Rosecott, which I think is working pretty well so far, we've got maybe 3 or 4 big factors we pay a lot of attention to. One, I've mentioned, is central bank liquidity, which, like or not, is sort of the governing factor. And then the other one is, which kind of grounds the relationship between bond markets, stock markets, currencies, and the economy, is what we call sort of the seasons indicator. And just a very simple way of putting that is that, the economy, like the seasons of the year, will go through phases. It'll go through a phase like the spring, when economic activity. So when on the slide there, when we talk about the indicator, it's simply an indicator of global economic activity. When it's beginning to rise, albeit from low levels, so things like inflation slowly picking up, employment picking up, then you get into sort of the summer phase, or the summer season. Things are much hotter. Companies are really hiring aggressively, investing. Then there'll be times when you kind of, you begin to kind of go over the top of the economic cycle, things slow down. Historically, central banks would be raising interest rates, business activity begins to slow, there's less job creation. Then you kind of get the winter phase after that, when things are quite icy, you're in a recession, business cycle indicators are negative, and companies beginning to restructure. And at this stage, central banks historically would have sort of cut rates to low levels and be trying to stimulate the economy, and governments hopefully would be doing that as well. So that's a sort of a framework. And bearing in mind, of course, that to what we said at the start, that the sort of business cycle we've seen recently has not been a kind of a typical one. But that gives you a sense of sort of the rise and fall of the business cycle. And then on the next couple of slides, I mean, what we've done, Daniel's done a lot of work here, where he looks at the performance of different asset classes during different types of behavior of the economy. And we've looked at, something like 60 asset classes, and I put some of them here. So, for example, in summertime, economically, when things are really hot, everyone is employed, everyone is busy, and lots of investment. Equities, commodities tend to do well. And then the inverse, when you're in a kind of deep recession, when you're in winter economically, things like fixed income, government bonds, treasuries do very well. Commodities are kind of flat because gold is doing well, oil maybe less well. Things like hedge funds, stocks are relatively underperforming. And then you kind of get a slightly different mix for autumn and spring. So it's quite intuitive in the sense that kind of riskier assets, equities, commodities do well when things are hot, and then safer ones, government bonds, gold, for example, do well when things are cold. And I think that the challenge for investors is you're never quite clear exactly where you are in the business cycle. So finding the right kind of combination of risky assets and safe assets through time is sort of what the job is all about. You can see then the practicalities of what we do. We then have different model portfolios or portfolio structures for different phases of the business cycle. So I'll just give you two examples. You see on the left-hand side, the one for summer, we have a lot, quite a bit of equities and commodities in there. In winter, it's largely kind of fixed income. We're taking a much, much safer, more cautious approach. And this probably looks quite simple. I mean, we have a whole range of indicators we use to try and tell us where exactly we are in the business cycle and the phase of the business cycle. And also, I think we adjust. So if kind of risky assets are really performing really well, more than we would expect, given the business cycle, we'll often pare them back if they're doing better than we might ordinarily think. Qiaojia, did you want to talk about this one? So will I give people sort of a sense of our thinking?
Based on what Mike has described, to make sense of the different seasons, if you like, of the business cycle, I think there's a couple of really important messages here. So one is that, people thinking investing the money has a risk because you may make money or you may lose money. And one thing people don't talk about so much is actually at least investing the money, making the right investment decisions gives you the opportunity of making money. If you don't and you hold your money in cash all the time, it just means that the investment, the value, the purchasing power of your money will be surely and gradually decreasing year by year, eroded by the inflation. So, we have talked enough about this in our previous webinars, so we won't go into depths again. And again, you can watch the full recording of the previous webinars at rosecard.com insight page. And the second thing is, there is a couple of really important Rose Cup principles, if you like. Before you dive into a portfolio and thinking, great, I'm going to invest the money, make some gains to beat inflation. It's really important to figure out where you are today, before you decide where you want to go. So this is where Roscat gives you a free tool to build your personal wealth balance sheet. So you have a clear picture of how much money you have with, a couple of questions, important questions to really help you to understand where you want to go and how likely you will be able to achieve it. Right, so that's our personal wealth balance sheet too, for you to figure out where do you stand today. And the third thing is that the lifetime cash flow projection. So it helps you to focus on the long term. In other words, your lifetime. As we mentioned, business cycles typically on average is 5 to 7 years. The last one lasted 12 years. Even that, your lifetime, let's say everyone lives up to 100 years, given the technology, you are still going to, experience at least 10, 15 business cycles. So, this is really important to focus on the long term of your wealth preservation and growth, rather having a knee-jerk reaction to sharp corrections in the market, such as March, the last March. And the third thing is, we have a plug and play portfolio composition that we'll be able to walk you through right now. But before we dive in, it's really important to point out that we use ETFs to construct the portfolio. ETF is a wonderful invention that basically lets you have a collective investment and avoid single company risk. Like what Mike has said, there are some companies are going to make it through the recession. Some others simply won't, right? They will just be overwhelmed by the debt or, by the loss of market share, loss of revenue and things like that. How much research you have to do to look into each company and be, comfortable enough that this company will make through the recession is a real test, even to the most experienced investors. And, and you don't have to invest your money that way. So this is why, we use highly efficient ETFs to construct the portfolio. So, here we can talk about, what the Rosca portfolio is made of compared to the traditional approach. So Mike, this is your brainchild. You might give us a few points here.
Yeah, sure. So I just, I'll say two things. So the investment process we have rests on a number of factors: business cycle, central bank liquidity, risk appetite, etc. And I kind of think in terms of three time frames. So we've on the right hand side, you've got the sort of the Rose Cup portfolio, which is kind of broken into four quadrants. The long term one there is what we call idiosyncratic, where we have basically investments that are long term. It can be real estate, it can be some themes, it can be different and new types of assets. The more standard type of assets, equities, and fixed income, they're driven more by the business cycle approach, and we tend to change that a bit according to the underlying business and economic cycle. And then we've got a part which here we've called the risk barometer driven, and that is really something that's driven by risk appetite in the marketplace. And what we really want to avoid, and this is my, I've tried to build in my experience of recessions and crashes and all that kind of horrible stuff into the portfolio, because in the investment industry, right, when you get a crash, and then a few weeks later your advisor says, oh, sorry, your portfolio is down 10%, but our competitor is down 11%, so that's okay. I mean, that means nothing to people. I've my experience of investors, be they institutional, private, sovereign wealth funds, is that what matters is absolute returns, what's the actual value of your money in your portfolio. So we've built in a lot of flexibility to the portfolio. So if for example we think that risk appetite in the markets is really extreme and people are getting carried away, what we'll do is pare back risk, and we'll become more cautious. And it's when people are doing stupid things, that's when you want to be exiting the market. And when they are getting really fearful, like they did in March, you want to be getting into the market. So I'll just give you an example. Your typical investment institution, I won't name any names, but the big asset managers, they typically have between 4 to 5% cash maximum. And we allow ourselves to have zero cash, and we would have zero cash. So we'd have everything invested most of the time, but we give ourselves the option to have 25% of the portfolio in cash in extremis if we think that things are going to be really, really bad on the road ahead. And in the run up to February, and we didn't foresee the coronavirus, but we thought markets were getting too high, we had about 15% in cash, which is 3 times what a normal investment institution would have. So that, I think, simply put, kind of gives us the space not to make stupid mistakes and to try and preserve the value of portfolios.
Great. I think, Mike, that kind of approach is really helpful even for 2019, when the market was generally doing really well. On average, we probably have, had a 10% cash in the portfolio to the time of the year, will achieve 16% return on a medium risk portfolio, where the market actually did 12% higher, percentage of the portfolio invested. So I think this is sort of the beauty of discretionary management. If you find the right manager with the right style that you identify with, the strengths of their investment expertise can save you a lot of time and get you, a proper return with, downside protection to a certain degree. And we also would like to point out the idiosyncratic illiquid assets here is often utilized by our clients who have a strong preference to express their wishes or convictions. Wishes is I want to back green technology. Convictions, is I think certain country or certain sector is going to do really well. So we have a curated list of 20 instruments to help them to express that view, rather than letting them, fishing through an ocean of, 3,000 on the normal trading platforms. So these are, the unique things about the Rose Cut portfolio that we like to share with you to see if you identify with. I think that brings us to the conclusion of today's webinar, is that one, you should be investing all the time rather than holding cash. And again, this message is that your retirement, your assets, your financial freedom needs to be earned. If you only make income from your work, it will not last, when you stop working. And so this message is loud and clear, and we keep repeating that. And so hopefully you understand the importance of investing by now. And the second, the market is not to be feared, but understood. It's really hard, we totally feel it with you, is that you always struggle with fear and greed different moments of the time, but there is a way to understand it. And the framework of cycle of seasons could be for that use. And third thing is that try not to time the market, because no one has a crystal ball to know exactly when to dive in and when to come out. What we could do is to maximize our time of, investing the cash in the market in the right approach, in the right segment, so we can earn the investment return. And the last is that to earn your financial future, please let Rose Cut to help you invest right. And I hope the content today will be able to give you more confidence and understanding of the investment approach at Rose Cut. So now it's our Q&A time. We have quite a list of questions to go through from here, but we will answer all the questions. So, do not hesitate to ask. And also, if you have time, please do give us feedback via the poll button. So the first one from Tiger, Mike, if you can answer this. European economy is really bad.
Yeah.
Why is euro so strong?
Okay, so I think on the euro, I don't think the euro economy is weak. What it lacks is high growth. So I think one of the discoveries we've had during the COVID period is Europe in general is probably more resilient than we thought. And I feel, as someone who's pro-European, there's an instinct in, say, New York, London, wherever else, that anytime there's a crisis, the euro must fall apart. And one of the lessons this time is that it hasn't. And actually, it's stepped forward. You've had this recovery and resilience plan. And the new thing about that is that the EU itself will be able to borrow and to tax. That hasn't been possible until now. So that's a new step forward in terms of making Europe fiscally more powerful. And I think it's helped to prove some of the euro bears wrong. And that's one reason why you've had the really strong rally in the euro. I think also there are concerns about the US under Trump and US institutions, which has kind of played the other side of the trade. But I think people went into the crisis believing Europe would fail, and it's emerged somewhat stronger structurally, even though we don't have that growth yet.
Great. Second question from Andrew. What is our view on dollar cost averaging? I will answer this. So basically, dollar cost averaging is a really good approach if you are able to save money on a monthly basis and put it into the market, so you even out the cost of purchasing each unit of financial instruments. However, this approach is less interesting if you already have a large lump sum of cash. As mentioned before, Coutts has done a proprietary study of their clients' investment for the past 50 years or so, and realized that if you have a large pot of money, by throwing it all into the market at one go versus putting it in over a couple of tranches, throw it into the market in one go is actually marginally better in terms of the return. Reason being, you are thinking about averaging your cost, but the chance of the investment value going up is similar to the chance of the investment value going down. You can't forecast that with accuracy at any given point of time. So for the future income that you haven't earned, dollar cost averaging is a good tool. For the cash that you already have in your bank account, we think you should go into the market in one go. And there's no point of waiting for a week or months. It doesn't make a difference, except you might be marginally worse off. The next question from someone anonymous: what is your perspective on LATAM? Is it too much different from what you have just developed on US, Europe? So basically, your view on LATAM, Mike.
So, I mean, LATAM is an interesting place, big in terms of populations, but frankly, kind of global-oriented investors don't spend a lot of time looking at it for one reason, that the pool of assets is very, very small. So stock markets, with the exception of a couple of companies, let's say in Brazil, Chile, one or two in Argentina, the market size in equities is very, very small. It's more interesting, I think, for fixed income, emerging market fixed income investors. And historically, because maybe markets have been less trusting of some Latin American countries, you've had higher interest rates. So any kind of recovery in their economies has been much more interesting. So it really is the preserve of emerging market fixed income specialists. And I think Latin America, like many other emerging markets, is always a place where institutions and the quality of institutions matter. I mean, Turkey is another example. We've seen a big fall in the lira in recent months because you've had this kind of degradation of institutions, geopolitical risk, etc. So these emerging market companies are companies where, you know, things like central bank liquidity matters much less, and things like geopolitics, institutions matter much more.
Got it. Actually, related to that, I have one anecdote to share. My co-founder Gustavo, had some investments in Brazil, and then he moved out of Brazil and have no clear plan of returning to Brazil. So we talked about this last January, about a year and a half ago. So I raised the question: look, from my perspective, if you have no clear plan of returning to Brazil, and why do you have all your investments in Brazilian real? And then, that kind of woke him up, and he switched most of his investment into US dollars and came to thank me earlier this year to say, how volatile the currency, in addition to the equity market, would have put him through hell if he hasn't done that, right? So this is another example of, even the market might work, may not, based on your knowledge, you still need to sort of, make sure that your personal plan is, compatible with your investment. And this is my role really as an investment advisor. Next question from Matthew. Some economists claim that the US has a privileged position as controller of the world's reserve currency. Sure, Argentina will regularly default, but Japan and the US never have, and arguably never will. So would debt to GDP ratio for these special countries really be good investment indicators?
Yeah, good question. So Argentina has defaulted 9 times, which is why you get those higher interest rates. The US is the linchpin of the global financial system. And there is a view in the US that they should take advantage of this effectively and issue even more debt, because they'll always be buyers for, the logic is that they'll always be buyers for dollars and dollar assets. You don't need Japan or the US to default to have a big move in markets, and I don't think they will default. I am worried about kind of financial accidents, particularly in Japan. So I do think I think it's a very pertinent question, because I think the next 2 or 3 years will be really important in the extent to which and the way people unwind this debt. And debt can be unwound in lots of different ways. You can grow your economy, you can have inflation, or you can restructure. And I think you probably eventually see more restructuring, which will be, again, interesting from a business point of view. It'll throw up lots of new debt classes. But I think we have to agree that in the long term, having a lot of debt to GDP, over 100% is just, it's like an economic handbrake. It slows down growth.
Great. Next question from Colin. Since you speak about the end of the globalization, is it that the access to finance will be more difficult for entrepreneurs? What advice would you have for them?
Yeah. I think that's interesting. So the end of globalization shouldn't make access to finance more difficult as such, because I think, first of all, one of the responses to the end of globalization is lower and almost permanently lower interest rates by central banks. If we do go into this kind of winter part of the business cycle, then surely banks will ration money to entrepreneurs. And we've already seen that, I think, from the start of this year, venture capital cutting back funding. I also think another interesting trend in the end of globalization is that means that big cities are still important, maybe more than some countries. So, London, Paris, Shanghai, Shenzhen corridor, Boston, New York, Silicon Valley will all be kind of, I think they will all be poles of entrepreneurship. And if I look at the UK economy, there's a huge difference in the financing that's offered to entrepreneurs in the north of England compared to London. And I think what you see is you have more entrepreneurs clustering around these big cities where you have kind of funding expertise as well as entrepreneurship expertise. So, it shouldn't necessarily mean the end of financing.
Great. The next question from Javier. How do you see ESG criteria for global asset managers after COVID? Do you think that social factors would gain predominance over the others in terms of the quantity of investment products available?
Yeah, good question. So lots to say about ESG because it's becoming very fashionable. It has done well performance-wise during the crisis because in the ESG kind of portfolios, you haven't had things like oil companies and airlines. I think it's a bit like religion, you know, how many times you go to mass every month, sort of thing. And there are different believers, and there are more companies who do not sincerely believe in ESG. So I recently had a call with a big German asset manager about ESG, and they were very enthusiastic, but the guy in the next room was the biggest holder of Wirecard, which is the biggest governance, which is the G in ESG. So people have to believe in it across the organization. And to answer your question, what I see is that different parts of it, you know, the E for environment, S for social, G for governance, have different levels of importance in different countries. So in the US, they focus on the S, the social. In Europe, they focus on E, the environmental. And in Britain, they focus on G, which is the governance. You know, so Germany, you've had lots of corporate governance scandals, but they invest a lot in green technology. So it depends on the region, I think.
That's really interesting. Next question from Sergey. What is your base case scenario for the pandemic/markets in the fall, given the potential for the second wave?
Yeah, I think it looks like there will be a second wave. It will be less severe because people are social distancing, wearing masks. I don't think that vaccines will be a kind of a blue sky cure because we don't know how effective they will be. We will still be worried about their side effects. And if you look at the medical literature, vaccines won't help everybody, certainly the weak and infirm. So I think there'll be lots of things that will come to pass in the fall. You have the election in the States. So my kind of rule of thumb is that in the next month or so, you probably see markets push a few percent higher, and then we will have something of a correction. That's my rule of thumb. I mean, I hate predicting short-term moves, but that's kind of what I'm thinking of. And I actually think that in terms, and this sounds a bit cruel, and I don't mean it to sound like that, but I think for markets, what would be more important in the fall will be the economic consequences of the first wave, indebtedness, etc., rather than the impact of a second wave. I think we just need to kind of see the long-term economic impact.
Great. Next question from Vic. Can you talk about asset inflation and general inflation risk? Inflation-proof investment recommended at this stage of the recession? What type of investment would this look like in equity and debt? Yeah. And I just would want to add another question in sort of related to that from Chen Hu to say, it seems that individual investors have very low chances to win because they don't have access to many instruments. Is this correct? So around the topic.
Okay, so let me take them first. I don't think, so I'm a bit worried by this whole phenomenon of kind of Robin Hood and stuff because half the people involved had not invested before. Most of them have not invested in options and derivatives, which can, you know, blow up your entire wealth in a few minutes. So I worry about that. So I don't, there are reasons, very good reasons why most people do not have access to kind of lots of instruments because historically, and you go back 400 years or more, people have been hurt by them, okay? Mm-hmm. And we have a period of maybe 2 or 3 months where it seems lots of people are making money buying, you know, crazy bankrupt stocks or whatever. And I don't think that is sustainable. And there are good reasons why in the past, when it's all come crashing down, people have regulated. So I think the regulations are there for a good reason. I also think that markets are not fair. I think you need to have a lot of insight, a lot of information to make money consistently in markets. So that's my kind of answer to that. On inflation, it's quite interesting because you would think that having had 10 years of expansion, we'd have lots of inflation, people buying stuff, building stuff. And the odd thing is that we haven't had consumer price inflation, the basket of goods we all allegedly buy. And I think there's two reasons for that. One is that after the global financial crisis, people have been quite careful in how they consume. A lot of them have a lot of debt. So there's no appetite to bid prices up, as it were. And the second reason is that a lot of the central bank liquidity has gone not into, it's a bit like plumbing and you kind of trying to divert a stream of water. Historically, it would go into the real economy. This time it's gone into financial assets. So the inflation has been in asset prices. Asset prices, if you compare the wage of the average worker in the States to the value of the S&P, that ratio is at an all-time high, okay, in favor of the S&P. So there's a bigger difference between kind of Main Street and Wall Street. So the inflation has gone into asset prices rather than into consumer prices. And that's something that central bankers, I think, just choose to ignore, because if they didn't ignore it and accepted it, I think they would probably be less generous with QE and regulate markets more aggressively. And they have done that historically. This band of central bankers haven't done so. And just I see there's a question there on sort of FANG and Tesla, etc. So that relates to my comments on kind of retail investing and inflation. I mean, the obvious way is to look at these stocks is look at standard valuation metrics. So the ratio of the price to their earnings. Tesla has no earnings. Well, it sells environmental credits. So yes, these stocks are massively overvalued, but they're in the grip of this kind of market liquidity at the moment, which is why they're going up. So, if you look at them on valuation alone, you wouldn't touch them. And that's a dilemma for a lot of investors.
Yeah, I think that's the content that we actually talked about. If people are interested, they're welcome to watch our monthly updates. And in the July market update, Mike and Daniel have provided quite a bit of a commentary on that, if you are interested. The next question from Matthew, won't the first vaccine approvals be a short-term positive catalyst for the equity asset class? Again, it's what do you think?
I think that's kind of in the price already. So there are 6 vaccines who are in stage 3. And if you look at companies associated with the vaccines, they've already done, Moderna, for example, is up by how many, 6 times. What the market is now saying is that the price of the vaccines is going to have to be kind of reasonable, right? $50 a pop. So that limits the profitability of the vaccines. So these companies have kind of pulled back a bit. In truth, we won't have, even for the earliest vaccine, we won't have it until probably the beginning of next year, even with accelerated approval. And I would say about maybe 40% of people in most countries will refuse the first vaccine shot for different reasons. And also bear in mind that these companies will be given legal immunity for the side effects of the vaccines. So it will be a very, very long time before everyone in the world is vaccinated for COVID. So I think even if we get a vaccine that works, it will be a long time before it is applied in practice and seen to work. The vaccine companies are doing 6 months what usually takes 6 years.
Yeah, I think in addition to what Mike has, further explained on the vaccine versus the market situation, I would want to say that, looking at the short-term drivers like that is not a great habit in general, because you have to decide what exactly is going to drive the market, and that's a view and that's a conviction, and you need to find the instruments that accurately reflects that view, and you need to decide at which price point that you will go into the market and at which price point you would come out, right? Like to really back it up with solid research, it takes a lot of time and a lot of experience. And my challenge to that would be, why do you want to do that? Like, if you want to, get a certain physical issue looked at, you might see a doctor, you might see a nutritionist, rather than pick up the medical book and learn that yourself. It's readily, a service that you can pay for. And the same thing with a wealth advisor like myself, or investment manager like, Mike and Daniel. There's a reason why this is a profession, because this is what we do on a daily basis over decades. So we have the expertise and the toolkits to deal with it. And a lot of people, sometimes make a decent profit or make a little bit different with a short-term trade without realizing for them to consistently make that profit over their lifetime, the much more, difficulties and challenges like, Mike just have just shared with you guys. So I think personally, I would strongly encourage people to focus their attention and energy on the big strategic decisions on your financial life, such as what is the right budget for you, so you save the right amount to be invested on an ongoing basis to reach the sufficient size of retirement pot at whatever age that you desire, so you get to live the life to your maximum potential in the way that you want, rather than worrying about whether I should buy Tesla or Amazon at what price, and how many times do I check my app a day to look at the price and to sell and to minimize the trading costs. This is just not the right thing for you to worry about. And I appreciate, previously access to quality financial advice is not, that available or whatever. And this is why we built Rosecard to change it. And so hopefully we can help you with that if you want to further explore this with us after this webinar. I think with that, we are at a point we have answered all the questions, and hopefully you guys find it helpful. And the last reminder for you to submit your feedback via our poll function. Thank you so much, Mike, for joining us today. We really appreciate you sharing the insights.
Thanks, Qiaojia. Thanks to everyone who joined, and stay in touch, everyone.
Great. Thank you very much. Bye for now.
Thanks.